Good morning, good evening, and good afternoon, everybody. Hope everybody's having a fantastic day. Today it is Wednesday, and it is time for HUBB Live with the one, the only Mike Wade. Today we're going to be talking about a quick market review. We're going to be going over our current portfolio. We're also going to be talking about last week's trade, and we're also going to give you a current trade, a trade for this week. Then we're going to go over some of your questions, some of your stock tickers that you want us to look at. And that was a mouthful. I guess we'll have to go ahead and get Mr. Mike Wade in here now. Mr. Mike Wade, come on in. How you doing today?
I'm doing good, buddy. How you doing, man?
Doing good.
I like those glasses. Those are
Thanks. Yeah.
I didn't know you had glasses.
No, I don't. They're like blue light glasses, so they help with like headaches, that kind of stuff. At least they're supposed to.
Yeah, they're supposed. I hope they do. The monkeys came back 2 days ago. They're not here today, but I fed them some bananas like Monday. So hopefully they'll come back during the show. And if they do interrupt me, because I want to feed them.
I gotcha. I gotcha. Well, what we got going on today?
Well, let's talk about the markets a little bit. There's actually 3 opportunities I want to take a look at today. And then I'm going to introduce you all to one of the other AI scanners called Sideways After Drop. So we're going to play with the software today. We didn't get filled on a trade last week. Unfortunately, that didn't fill. So we're just going to play with the software. But before we do it, let's talk about the markets. So after we met last week, the Fed came out and dropped rates by 50 basis points, which is 0.5%. And this is what happened on the day right there. Let me zoom this chart in a little bit. And you can just click and drag on the bottom margin and zoom in. So this is what happened. This was all-time high territory at 565. Let me turn on creator mode so you can see my charts a bit better. So 565 was all-time high. This is called a resistance level. It's also what's called a cup. Follow my fist there. And a little bit of a handle, although the handle's a little wide. So we get this consolidation. And then the Fed says, all right, we cut our rates 50 basis points, probably going to cut them by the end of the year again. The jobs market is holding up strong enough. The consumers are buying stuff. Inflation's dropping. Rainbows, birds, and sunshine. And the market goes, we went up and then we came back down below this 565 level. So that was a bit surprising to a lot of us. But the next day, it was here's this. The next day, you can see here, the SPYs gapped up to all-time high territory on above average volume. All right, so it was like, is that good news or bad news? The markets digested it, and the next day it was like, wait a minute, that's really good news. And so the market gaps up on high volume. The SPYs, this is the ETF that tracks the S&P 500. And then let me zoom this in because if I could, when I teach anybody about trading, the thing that I love the most on a chart is support and resistance. It tends to live at round numbers. It's driven by institutional humans that are programming their computers at round numbers, and it tends to work. It works more often than it doesn't. And so with that established, once again, I know I get evangelical about support resistance because I've been doing it for 25 years. And in my view, the strongest thing you can put on a chart is support resistance because it's derived by humans that think in round numbers. So we got this big move up, all-time highs, and then the markets came back down the next day. And then look where the bottom of this pattern is, this wick on this candle pattern bounced almost exactly off 565. And the volume on that day was above average. All right, so what that means is this prior resistance level at 565 became support here and then was tested here. And we got this nice, it's called a hammer pattern, where the markets tested 565 and closed higher than they opened. And then we get another high. And then yesterday we closed at an all-time high. And so the markets are sort of digesting. They're establishing this new range. 565, we've been above it for 1, 2, 3, 4.5 days so far. And that just tells me that the likelihood of the markets correcting from a technical basis are reduced with every single day that the markets, the SPYs in this case, close above 565. So my prognosis is decidedly bullish. I know that more rate cuts are coming. Inflation is cooling off. The jobs market is strong enough. It's not contracting anymore. Consumers are buying. So I think long-term bullish. We're digesting the new climate, and I love it. I think once we start setting new highs here, expect the SPYs, the diamonds as well is in the same pattern. I'll show you the diamonds here. This is the Dow Jones Industrial Average, simply 30 stocks, excuse me, not three, 30 stocks, similar pattern here as well. So I see bullish on the Dow Jones, bullish on the S&P 500, the NASDAQ. We can go to the Qs here, and the NASDAQ is ready to break above this level here. All right, so similar pattern above 480. Let me show. This is so beautiful. Ryan, I can tell I'm in the right business, if you want to call it a business, because I still get really excited when I see the power of support and resistance. And so you can see here that the Qs are wrestling with 485. That's resistance there. It's resistance the last 3-4 days, and it was support resistance over here as well. So what I'm looking for here is for there to be a close on the Qs above 485, round number, above 485, coupled with some high volume, and then I would expect the Qs to follow along with the SPYs in the S&P 500, or the SPYs, which is the S&P 500 and the NASDAQ, the Qs. Now, the other one I want to look at here is the IWM. These are small caps, and small cap companies do really well in a lowering interest rate environment where interest rates will be dropped. Provided the data supports it, we can expect there to be a sequence of rate cuts, and the smaller cap companies, the smallest 2,000 companies in the US market, presumably use more credit debit loans. They borrow more money, and as interest rates drop, they can do that. The cost of their money drops, and eventually what I expect to see is the Russell 2000, IWM in this case, the ETF that tracks the Russell, and I see strong resistance up here at a round number. Look at this, bounce, 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 nope, consolidation movement, bounce, bounce, coming down a bit. So I would go bullish on the Russell with a close above 225. Write that stuff down because it works, except when it doesn't, but it works more often than not. So Ryan, I'm feeling pretty good about the bullishness in the markets. We do have another show that starts 9:15 every Thursday morning, and we do have a performance from that show. Now, we don't lean just on AI. We have other systems that are credit spread based, and that's where I'm focusing this show as well, is credit spreads. And that performance, Ryan, has been pretty good, wouldn't you say?
Yeah, not too bad at all.
Yeah. We have, since we started this sniper show this year in Snipers Thursday morning, 37 out of 40 wins. What? Yeah, 93% wins. The average gain over a 5-day period, 13.5%. All right, so come to that show in the morning, and we'll give you this guidebook that will tell you all about the support resistance systems that I use. It will also show you what a credit spread is, the kinds of news we like to trade. And if you want to play around with that kind of a win rate, then come join us on Thursday mornings at 9:15 on the HUBB channel. All right, Ryan, what do you think? Should we do some trades? What are your thoughts?
Absolutely, we should.
Let's do it. Let's do it. And we've got 3 of them here. So I didn't even tell you what I did. Click the AI button, and then over here you've got wave 3 bullish, wave 3 bearish. I've selected wave 3 bullish, and check out some of these stocks. There's 3 of them, IWZ, CMI, and MAC, that have confidence scores over 75%. And if we take a look at some of these here, we'll look at the first three of them. Here's Invesco Limited. Yesterday, we got a nice little run up on above average volume. The confidence score is 89% that this stock will reach this target. From an AI, the AI scores are derived from huge number crunching, looking at intermarket analysis, all sorts of things that give it a really nice confidence level. These signals have proven to be very valuable and very accurate over time. And so I see this one, and I'm like, man, I with that volume there, that big run up yesterday, a little bit of a pullback today, no big deal. I like this one, perhaps selling. And we'll look at some of these. Maybe we'll do all of them. But, if you can sell your credit spread down here, maybe at 1650, if there's a strike there anyway, then this trade here, if we put this credit spread on here, we have a line in the sand that we make money anywhere above 1650. I know there's not a strike there, but let's just for the sake of argument. So sell your credit spread, put your line in the sand, in other words, at or beneath the fail zone. That's ideal if you can get enough credit. And then you'll make money on this trade if the stock rises, goes to the moon, goes sideways, or even drops a little bit, and you'll make money. So that's probability. Even without the AI score, you'll have a good shot of the stock remaining above 1650. If you think about the stock let's just assume the stock has random probability of going up, down, or sideways. And so that's each direction is 33%. So you've got a 33% chance the stock will rise, 33% chance the stock will drop. That's 66% probability of random probability of profit, and even more given that the stock can come down. And you can still make money on this trade up, down, a little bit, sideways. It's well over a 67% random probability that these trades make money. And then you couple an AI signal of 89, which says, well, the stock is probably going to go up. And then that probability of a profit goes even higher than 70%. Typically, we're in around 80, 90% probability of profit on these things. So that's the system. It's a different approach. A lot of people like Rob like to trade directionally. I do too. I do different ways of trading directionally. This is credit spreads are only one of the things that I do. I do many other types of option strategies. But there's a lot you can do. Buy a call option, buy the stock. And if that stock does rise to 89, you're going to get paid. So my ballpark here with all of you is credits. So let's just go through all three of these. The other two that we'll look at as well also have really nice scores, 80% or higher. So what you do here, and eventually you'll be able to click this button down here that says options. And it'll give you an option chain, a live option chain. And then you can start building your trades on a live option chain. And so what I would like to do here is sell at 1650. And I see here the strikes. These are 23-day options as well. I like 14 days, 21 max. So we're kind of in the ballpark here with 23-day options. Short-term high probability profits is the name of the show tomorrow. And that's what I'm showing you here. So I like that number to be around 14 or so, but it's a little longer than I like. And then I take a look at the puts over here on the right, and I can just roughly see here that if I was to sell the 16 put and then buy the 15 put, that creates a credit spread. And it shows a 10-cent credit here on the HUBB platform. So let's go try this in a live account. This is live trading here, y'all. And the symbol is IVZ. I'm in a simulated environment here in Thinkorswim, so I can show you exactly how to place these trades. So here's 1615, expiration October the 24th, 23-day option, all the same that's in the HUBB software. I'll click the sell side. So here I've just built the trade, and the trade would be, I'll give you this in a few minutes, but if we could sell the 16 put for October 18th on IVZ and then buy the 15 underneath, that's a credit spread. It's only showing 5 cents as a mid price. My minimum on these is 10% of the distance between the strikes. So there's $1 here. So I want 10 cents. I could put a line in the water and say, all right, I'm not taking 5, but I'll take 10 if you'll give it to me. And then I can confirm and send that and just drop that hook in the water. And I would say that trade would be valid, for a while now. So just let it sit on. If the stock comes down a little bit more today, or maybe set our line in the sand in the right place. So here's our line in the sand. So this stock could drop all the way down to the target and fail on the AI signal. It would then have to cross below the 50-day average. It would then have to cross below the 200-day average. And those are support levels. So is 17. So this stock's really going to have to hammer down before we'd lose money on this one. So I'm going to put that in. I already have. And let me give you this trade in a perhaps more pleasing format. So I'm going to take you to my nifty little spreadsheet so that it's really clear. IVZ is the symbol. And we are going to sell the 16 put. And we're going to buy the 15 put. And I want a minimum of 10 cents. Yeah, but it's only worth 5. I know. But if the stock comes down a little bit, we might catch a fish. So I drop that in the water and I wait. Stock drops a little bit this morning. We could get a little bit extra credit. So fishing, allowing the trade to come to you. No reaching, no pining, no desperation. I got to have it. I'm going to take 5 cents. No. Follow the rules. Let the trade come to you. Detach, react, manage your risk. Let the winners take care of themselves. If you actually really and truly trade in that way, your trading psychology will be much more peaceful. Rules, detachment, allowing the trade to come to you. All those things I just said are really the hallmarks of a healthy trading psychology. All right, we may get that one, we may not. Well, let's go do another one. Why not? The next one on the list here is Cummins. All right, nice little pattern as well. Similar to the last one, Cummins yesterday gapped up above 310 here. Let me draw a line in the sand. There's 310, and it breached 310 here 3 days ago. Yesterday, monumental breach of 310 on extra volume. So even without this 86 score, this stock has a high probability of continuing up and an even higher probability of not dropping back down. So once these resistance levels are breached, here's another one right there at the top of those bars. So once these levels are breached, and particularly if these resistance levels span over a long period of time, as this one does, check this out. Check this out. The stock, this is a multi-month high, probably an annual high, if not an all-time high. And all of that, all by itself, would be enough for me to sell a credit spread on this trade and then couple it with an 86% confidence rating that the stock will hit 345. Man, I'm all over this one. This is a super duper one. And the next question is, how close do I want to get? Well, can I get something down here at 300? All right, can I put my line in the sand down here at 300? Just beneath the fail zone. Well, yeah, I'd like to. Maybe there's credit there. We have to go take a look. This is all live. I haven't even checked these trades out beforehand here. I knew what these were, but I haven't even looked at any credit spreads. So this is exactly how I do it live every morning. I trade this system. So is there anything at 300? Let's go look. I'm going to go into the simulated environment again. The symbol is CMI. And again, a similar situation. The expirations are 23 days long. 21 days is usually my max. But with all this probability, I'd be willing to consider a 23-day trade. And then I come on down here and I look at the 300 290s. If I click sell here, This is the trade that I like. It's selling the 300 put and buying the 290. What's my minimum credit on these? Well, 10% of the spread width, which would make this $1. That's $10. I want $1 credit. Is there 10% of $10 is $1? And $10 wide, 10% of $10 wide is $1. I'm only seeing 65 cents. I'm 35 cents away. So similar to the last trade, I could put an order in to grab it for $1. And if the stock drops a little bit, we'll get filled. Now, another thing I sometimes do is, well, what if we lifted the strike, the line in the sand up and go on the other side of this? And it looks like, based on the option chain, the 310, 300 is the next increment up. So now I look at this going, well, 310 is a little closer than I'd like to be. The credit is actually pretty wide on this. Let's try it. Let's go down. Let's go up to 310, putting our line, our hook in the water, our line in the sand much closer to the stock. And there we have $1.45 on a $10 spread. So that's 45 cents higher than the minimum. So that would be a reasonable trade. It's not ideal because the line in the sand is a lot closer to the stock. So here's what I'm going to suggest. You know, in my own account, I might take that, but I want to keep everybody safe. So let's be conservative and let's go after the 300. So I'm going to go back to the 300, sell the 300, buy the 290 for $1 credit. Now listen, you can put this trade on later in the week. So you don't have to go rushing after it. Just stick it on there for $1. You do one contract here, confirm and send, and send. We've dropped another hook in the water. And now we have two trades that if the stock drops a little bit, we can get our line in the sand exactly where we want it. So let me show you this one on CMI in my nifty little spreadsheet here. CMI is the stock symbol. We're going to sell the 300 put, and then we're going to buy the 290 underneath. And the minimum credit for that one, y'all, is $1. Okay? So there's another. Again, you don't have to get filled today. You've got, you got weeks, a couple of weeks potentially to grab these. All right, one more on Mac. And this is McCarrick. And you can see here, same sort of pattern, confidence rating 80%, stocks due for a rise to 1893 target, and the fail zones down here at 1650. So guess what? I'd like to get my line in the sand at 16, right there. All right, so 16 is below the fail zone. Let's go see what we can get on it. I don't know. I'm going to go see. Mac. And then my short strike is 16. That one also has a 5-cent credit. That's okay. I'm gonna fish for 10. Confirm and send. And there we have 3 hooks in the water. Look at this one on CMI. It's already up to 82 cents. CMI must be dropping a little bit. Let's take a look at it. As the stock drops, the credits increase for these put spreads underneath. The stock's coming down a little bit. So we got a good shot of getting filled on that one. I will track it. All right. So, and then if you look at the bearish signals, there just aren't any. If there's the scores we look for are 75 or higher, or 25 and lower, and we don't have any bearish signals we can consider. So Ryan, I was going to show one other thing here. It's another AI signal that we haven't touched on yet. But are there any questions or stocks for us to look at, brother?
No, not yet. There is one person that said there is only an 18 October IVZ trade, not an 8 October.
Yeah, that's okay. That's okay. 21 days is sort of where we want to be. Now, the other thing about the AI signals is because they work so well, we can hang into these trades for a bit longer. So as I look at, the sniper rules are 14 days, 21 days max, but because of the reliability of the AI signals, as we start to find our way with this system, I'm more inclined to go beyond 21 days on these AI signals, particularly if the line in the sand is below the fail zone. All right. So, and listen, you don't have to get in today on these. Unlike the snipers that we do Thursday mornings, we get in at the market open on gapping stocks and we take advantage of selling expensive options. We don't have that here. So we don't have to get in today. So all these three trades that I've just shared with you, here they are. Just fish. Follow these rules that we're sharing here in the HUBB AI show for short-term high probability profits. So good question. I hope I've answered that one. Now I wanted to show you another signal here. And this one is sideways. Let me slow down, Mikey, and tell you what I'm doing. So right now, the signals being shown are Elliott Wave 3 signals. And if you click these three buttons here, there's also an AI signal called sideways after drop. So let's select that. And what this looks for, as the name implies, is finding stocks that have dropped and what's the likelihood that those stocks will go sideways. In fact, more detail, what's the likelihood that this stock on Light and Wonder, which tanked below the 200-day average and has already started to go sideways, what's the likelihood that it's going to stay between this upper boundary of 97.65 and the lower boundary of 83.77? Well, it's 55%. Now, I like the signals to be, close to 75%. But, so I don't love this one. But what I do love about it is that the likelihood of the stock coming back up here to the upper boundary, let me zoom in a little bit. The likelihood of the stock recovering up here is interrupted by this 200-day moving average. This line here is one of the strongest moving averages. It's the strongest moving average that you can put on a chart. Institutions dump the stock below the 200-day average. If they like the stock, they would have kept it above the 200. So we can tell here they don't like the stock. They're not expecting it to rise. It's unlikely, although it could happen, it's unlikely that we'll see the stock recover above this 200-day average, the blue line here. So I feel pretty good about putting a line in the sand up here, 97.50 or so, just, somewhere in here. I'll have to see what strikes are available. So we could construct a trade that would make money below this point. I think that's a pretty good bet. And then the other thing you can do, if you trust this signal, and it's not as high as I'd like it to be, but you could also say, all right, well, I'm going to sell another credit spread down here as close to that lower boundary as possible. And then you get a trade where you sell two credit spreads, and this trade will make money as long as the stock stays within the lines in the sand. So I'm going to build this for you. This is an advanced idea. These are called iron condors. Don't get too freaked out about the words iron condor. It's literally two credit spreads, one up here, one down here. So let's go take a look here and go to the option chain. I'm going to use Tom's tools. I know many of you have Tom's tools on this call. I just want to build the risk graph so you can see what it looks like. So the symbol is LNW, and I see 23-day options. Same rules apply. 14 days is better. 23 days is a little long for me, but I want to build the condor and then sort of inspire you perhaps to start playing paper trade these if you've never done them, and just start paper trading and start practicing. And so when I go back to my lines in the sand here, I would like to sell somewhere above 97.65. I don't know what strikes are available, so I got to look. So let's go back to the option chain here. Make sure I'm on the right date here. LNW. And on the call side, keep flipping to the wrong screen. On the call size, somewhere above 98 is where I'd like to be. Maybe it's going to have to be 100. Let's just see. So we got 95. That's too close. So what I'll do here is I'll sell the 100 call option, and then I'll buy the one above. So that's a bearish credit spread. And I can see that there's going to be some decent credit there. And then on the bottom side, I'll sell another credit spread. I'd like to be below 83.77, please. Let's see what's there. So I've got 75. This would probably work. I'm going to sell the 75 put and then buy the underlying. What's a credit spread? How do I build them? Get the guide. Come to the show tomorrow, and you get a free guide, and it'll talk to you about how to construct a bullish credit spread and a bearish credit spread. And that's what I just did. Here's what the risk graph looks like. Baby. Good God. Oh, I shouldn't say it like that because it sounds like advice. The only thing that's really crappy about this trade is the slippage is gargantuan. You see that? 0 by 235, 0 by $1. We're not likely to get much there. We could try. But what's beautiful about this risk graph is you have a credit spread up here, a credit spread under here, and as long as the stock continues sideways within this massive range, then you'll make some money on not one credit spread, but 2 credit spreads. All right, now I could tell more. I'm sort of hesitating to talk too much about these because I don't want to freak anybody out, but I'm going to do it anyway. Ryan, when people say, well, I hate to be rude, but let me be rude. I hate to be complicated, but let me be complicated. So the way these work is there's risk in both of these spreads here. This one here is the 100, 105 bear call spread. It has risk. The stock goes to 106, really motors up beyond this upper strike. You're going to lose all your money on that one. So that has max risk to it. So does this one here underneath. But the beauty of these is that you can't lose on both sides. So when you grab 2 credits, your broker will only require that you cover the risk in one. What does that mean? It means that the potential return on investment by selling 2 of these is greatly magnified than just selling one. So this trade, if we were able to get filled, and I don't think we can because of the slippage. I'm going to try here in a minute. This trade is just gorgeous. The stock can go pretty much anywhere, go sideways. It's probably not going to rise above the 200. What's he talking about here? It's probably not going to go above this blue line, which is about 96. And it might drop further, but it's going to have to drop a lot. Let me show you the lines in the sand that we just built. So the 100 call, the short 100 call is right up here. What? The lower put is at all the way down to 75. What? Are you serious? Look where this is. It's off the charts, literally. It's down here. All right, now you know what I'm going to do here? I'm going to lift the bottom spread up to 80. Okay, so let's do that. We're going to get a bit more credit. There might be some more liquidity there too. So let's sell the 80 and buy the 75. What's he doing? I don't understand. Here's what I just did. Visually, what I just did was I lifted my bottom put spread, my line in the sand to 80. So by doing that, I'll get a bit more credit. So let's see what it looks like now. Yeah, the slippage is so crazy on this one. Unfortunately, this one's not going to really work out. because the slippage is just gargantuan and it's not even showing a credit here. So that's not a really good trade for us. But the reason I wanted to spend a bit of time on iron condors is because going forward, we're going to find these and we're going to play with them. And I can just go back and look at some other dates here. Here's a good one here. So that has 76% confidence score. I went back to the 23rd. This one is also a really nice one as well, because what's better about this one is that you have a 76% confidence rating that the stock is going to stay within this backyard here. Well, heck, let's build this one. So the stock, this is what I think I'm going to be able to do here. We're going to sell at 16 and 12. This might be a good one. Let's sell at 12. So what do we have here, Mike? Well, we're going to put on a trade that as long as the stock stays below this line and above this line, we're going to make money. And we have a 76% confidence rating that the stock will stay within this upper boundary and this lower boundary. So from an AI score, we have a 76% chance of the stock staying in this little backyard here, but we're even beyond it. So our probability is actually higher than 76% that the stock will remain below 16 and above 12. So let me build that. Now Mikey's playing. I can't help it. This stuff is so fun. What is the symbol again? MNSO. It's not a well-named, known stock. Now, you know these sessions are recorded, right? So if you want to learn more about iron condors, then watch the recording, because we're going to start doing some of these. Okay. Where am I going to sell? 1530 or higher. So I'm going to have to, oh, wow. Well, let's just build it. So the only one I can sell on the call side is 1750. Let's buy the next higher. And then on the put side, I can go to 1250 or 10. Where do I need to go? Yeah, 10 is as close as I can go. I can't go to 1250 because that would put my line in the sand within the AI boundary. Not doing that. 10 is the only choice I have. Let's see if there's any credit there. Maybe. No, there's not. All right. So this one doesn't work out either, but that's the strategy, Ryan, we're going to start playing with. I've got my eye on these. If I see them, I'll certainly give people some fish to play with. So last call for questions, Ryan. Any questions, comments, stocks, anything?
No, I'm not seeing anything right now.
All right. Ryan, that's a wrap for today, brother. What are you doing tomorrow at 9:15?
Oh, man. I wish I'll be sleeping. Just kidding.
You know, for me, man, it's like at 7:15. It's 9:15 for you.
Oh, yeah.
You know, it's like,
yeah. I mean, I'm already up and with the kids and all that stuff, you know.
Yeah, I know. You got young kids, yeah. Hey, let's show that guidebook real quick here, Ryan.
Yeah, I think that's a good idea.
Yeah, I haven't. We've been mentioning it, but you know, I've written this guidebook that will take you through the 5 steps of credit spreads, and this is the system that I use here. But really, with news and gapping stocks in the morning on Thursday morning, grab it. It's a 5-step process. It'll walk you through every step. How do you identify candidates? What's good news, bad news? What's a credit spread? How you derive support resistance, or as I call them, lines in the sand. And it will walk you through step by step. So if you grab that guide tomorrow, if you don't have it already, and read it, you can come and join Ryan and I every Thursday morning at 9:15 and watch us do what we do. All right, Ryan, that's a wrap for today. Bye, everybody. Have a good afternoon, and we'll see some of you tomorrow morning at 9:15 Eastern on the HUBB channel. Bye, everybody.